Let us now commence this module by studying about the accounting standards meaning. In India, the term standard has become popular since the formation of Accounting Standards Board ASB in April 1977 by the Institute of Chartered Accountants of India. The term accounting standard may be defined as written statements issued from time to time by institutions of the accounting profession or institutions in which it has sufficient involvement and which are established expressly for this purpose. Such accounting institutions bodies are currently found in many countries of the world. For example, Accounting Standards Board India, Financial Accounting Standards Board USA, Accounting Standards Board UK, Accounting Standards Committee Canada, etc. At the international level, International Accounting Standard Board IASB has been created to formulate and publish in the public interest basic standards to be observed in the presentation of audited accounts and financial statements and to promote their worldwide acceptance and observance. Littleton defines standard as follows. A standard is an agreed upon criteria of what is proper practice in a given situation, a basis for comparison and judgment, a point of departure when variation is justifiable by the circumstances and reported as such. Standards are not designed to confine practice within rigid limits but rather to serve as guideposts to truth, honesty and fair dealing. They are not accidental but intentional in origin. They are expected to be expressive of the deliberately chosen policies of the highest types of businessmen and the most experienced accountants. They direct a high but attainable level of performance without precluding justifiable departures and variations in the procedures employed. Accounting standards do not aim to put accounting in a straitjacket. Rather, they attempt to limit the theoretical possible flexibility and to give practitioners realistic working guidelines. If individual circumstances of a particular business firm are such that an existing standard is not suitable, then alternative practices regarded as more suitable can be adopted. After studying this module, you shall be able to understand the meaning of accounting standards and their relevance in reporting, learn the process of issue of accounting standards, identify the need for their issue, know the need for global convergence of accounting standards, learn the role of National Financial Reporting Authority in compliance of accounting standards. Let us now discuss about the accounting standards setting process. The Institute of Chartered Accountants of India ICAI, being a premier accounting body in the country, took upon itself the leadership role by constituting the Accounting Standards Board ASB in 1977. The ICAI has taken significant initiatives in the setting and issuing procedure of accounting standards to ensure that the standard setting process is fully consultative and transparent. The ASB considers the International Accounting Standards IAS, International Financial Reporting Standards IFRS while framing Indian accounting standards and try to integrate them in the light of the applicable laws, customs, usages and business environment in the country. The composition of ASB includes representatives of industries namely ASSOCHAM, CII, FICCI, regulators, academicians, government departments, etc. Although ASB is a body constituted by the Council of the ICAI, ASB is independent in the formulation of accounting standards and Council of the ICAI is not empowered to make any modifications in the draft accounting standards formulated by ASB without consulting with the ASB. The standard setting procedure of Accounting Standards Board ASB can be briefly outlined as follows. First, identification of broad areas by ASB for formulation of AS. Second, constitution of study groups by ASB to consider specific projects and to prepare preliminary drafts of the proposed accounting standards. The draft normally includes objective and scope of the standard, definitions of the terms used in the standard, recognition and measurement principles wherever applicable, and presentation and disclosure requirements. Third, consideration of the preliminary draft prepared by the study group of ASB and revision, if any, of the draft on the basis of deliberations. Fourth, circulation of draft of accounting standard after revision by ASB to the council members of the ICAI and specified outside bodies such as Department of Company Affairs DCA, Securities and Exchange Board of India SEBI, Comptroller and Auditor General of India C&AG, Central Board of Direct Taxes CBDT, Standing Conference of Public Enterprises etc. for comments. Fifth, meeting with the representatives of the specified outside bodies to ascertain their views on the draft of the proposed accounting standards. Sixth, finalization of the exposure draft of the proposed accounting standard and its issuance inviting public comments. Seventh, consideration of comments received on the exposure draft and finalization of the draft accounting standard by the ASB for submission to the Council of the ICAI for its consideration and approval for issuance. Eighth, consideration of the final draft of the proposed standard by the Council of the ICAI and if found necessary, modification of the draft in consultation with ASB is done. Next, stages of issue of accounting standards. First, identification of area. Next, constitution of study group. Next, preparation of draft and its circulation. Next, ascertainment of views of different bodies on draft. Next, finalization of exposure draft. Next, comments received on exposure draft. Next, modification of the draft, and last, issue of accounting standard. Let us now understand the benefits of accounting standards. Accounting standards seek to describe the accounting principles, the valuation techniques, and the methods of applying the accounting principles in the preparation and presentation of financial statements so that they may give a true and fair view. By setting the accounting standards, the accountant has following benefits. First, standardization of alternative accounting treatments. Standards reduce to a reasonable extent or eliminate altogether confusing variations in the accounting treatments used to prepare financial statements. Second, requirements for additional disclosure. There are certain areas where important information is not statutorily required to be disclosed. Standards may call for disclosure beyond that required by law. Third, comparability of financial statements. The application of accounting standards would, to a limited extent, facilitate comparison of financial statements of companies situated in different parts of the world and also of different companies situated in the same country. However, it should be noted in this respect that differences in the institutions, traditions, and legal systems from one country to another give rise to differences in accounting standards adopted in different countries. Moving on to the limitations of setting accounting standards. However, there are some limitations of setting of accounting standards. First, difficulties in making choice between different treatments. Alternative solutions to certain accounting problems may each have arguments to recommend them. Therefore, the choice between different alternative accounting treatments may become difficult. Second, lack of flexibilities. There may be a trend towards rigidity and away from flexibility in applying the accounting standards. Third, restrictive scope. Accounting standards cannot override the statute. The standards are required to be framed within the ambit of prevailing statutes. We shall now understand the accounting standards. The Council of the Institute of Chartered Accountants of India so far issued 32 accounting standards. However, AS 8 on accounting for research and development has been withdrawn consequent to the issuance of Accounting Standard 26 on tangible assets. Thus, effectively, there are 31 accounting standards at present. The accounting standards issued by the Accounting Standard Board establish standards which have to be complied by the business entities so that the financial statements are prepared in accordance with generally accepted accounting principles. Accounting standards mandatory as on September 1, 2014. AS1 disclosure of accounting policies, AS2 valuation of inventories, AS3 cash flow statements, AS4 contingencies and events occurring after balance sheet due, AS5 net profit or loss for the period, prior period items and changes in accounting policies, AS6 depreciation accounting, AS7 construction contracts, AS8 accounting policies, changes in accounting estimates and errors, AS9 revenue recognition, AS10 accounting for fixed assets, AS11 the effects of changes in foreign exchange rates, AS12 accounting for government grants, AS13 accounting for investments, AS14 accounting for amalgamations, AS15 employee benefits, AS16 borrowing cost, AS17 segment reporting, AS18 related party disclosures, AS19 leases, AS20 earnings per share, AS21 consolidated financial statements, AS22 accounting for taxes on income, AS23 accounting for investments in associates in consolidated financial statements, AS24 discontinuing operations, AS25 interim financial reporting, AS26 intangible assets, AS27 financial reporting of interest in joint venture, AS28 impairment of assets, AS29 provisions, contingent liabilities and contingent assets. Accounting standards not mandatory as on September 1, 2014, AS30 financial instruments recognition and measurement, AS31 financial instruments presentation, AS32 financial instruments disclosure. Now moving on to the NFRA and accounting standards compliance. National Financial Reporting Authority NFRA under Companies Act 2030. Section 211 required that the every balance sheet and profit and loss account of the company shall comply with the accounting standards as may be prescribed by the central government in consultation with the National Advisory Committee on Accounting Standards. Therefore, Section 210A was enacted to constitute an advisory committee to be called National Advisory Committee on Accounting Standards to advise the central government on the formulation and laying down of accounting policies and accounting standards for adoption by companies or class of companies under this Act. In Companies Act 2013, the nomenclature of National Advisory Committee on Accounting Standards has been changed as National Financial Reporting Authority, and unlike NACAS, it will not merely be an advisory body but a regulatory authority for auditing, accounting and financial reporting. NFRA shall be responsible for monitoring and enforcing compliance of auditing and accounting standards, and for that purpose oversee the quality of professions associated with ensuring such compliances. The authority shall investigate professional and other misconducts which may be committed by chartered accountancy members and firms. There is also a provision for appellate authority. The National Financial Reporting Authority shall be a quasi-judicial body to regulate matters related to accounting and auditing. With increasing demand of non-financial reporting, it may be referred to as a national level business reporting authority to regulate standards of all kinds of reporting, financial as well as non-financial, by the companies in future. The authority will also change the way for notifying, I repeat, the way of notifying of accounting and auditing standards, as is evident from provisions of clauses 133 and 143 of the Companies Act 2013. Let us now discuss about the need for convergence towards global standards. The last decade has witnessed a sea change in the global economic scenario. The emergence of transnational corporations in search of money, not only for fueling growth but to sustain ongoing activities, has necessitated raising of capital from all parts of the world, cutting across frontiers. Each country has its own set of rules and regulations for accounting and financial reporting. Therefore, when an enterprise decides to raise capital from the markets other than the country in which it is located, the rules and regulations of that country will apply, and this in turn will require that the enterprise is in a position to understand the differences between the rules governing financial reporting in the foreign country as compared to its own country of origin. Therefore, translation and reinstatements are of utmost importance in a world that is rapidly globalizing in all ways. In themselves also, the accounting standards and principles need to be robust so that the larger society develops degree of confidence in the financial statements which are put forward by organizations. International analysts and investors would like to compare financial statements based on similar accounting standards, and this has led to the growing support for an internationally accepted set of accounting standards for cross-border filings. The harmonization of financial reporting around the world will help to raise confidence of investors generally in the information they are using to make their decisions and assess their risk. Also, a strong need was felt by legislation to bring about uniformity, rationalization, comparability, transparency and adaptability in financial statements. Having a multiplicity of accounting standards around the world is against the public interest. If accounting for the same events and information produces different reported numbers depending on the system of standards that are being used, then it is self-evident that accounting will be increasingly discredited in the eyes of those using the numbers. It creates confusion, encourages error and facilitates fraud. The cure for these ills is to have a single set of global standards of the highest quality set in the interest of public. Global standards facilitate cross-border flow of money, global listing in different bourses and comparability of financial statements. The convergence of financial reporting and accounting standards is a valuable process that contributes to the free flow of global investment and achieves substantial benefits for all capital market stakeholders. It improves the ability of investors to compare investments on a global basis and thus lowers their risk of errors of judgment. It facilitates accounting and reporting for companies with global operations and eliminates some costly requirements, say reinstatement of financial statements. It has the potential to create a new standard of accountability and greater transparency, which are values of great significance to all market participants, including regulators. It reduces operational challenges for accounting firms and focuses their value and expertise around an increasingly unified set of standards. It creates an unprecedented opportunity for standard setters and other stakeholders to improve the reporting model. For the companies joint listings in both domestic and foreign country, the convergence is very much significant. Let us now understand the International Accounting Standards Board. With a view of achieving these objectives, the London-based group, namely the International Accounting Standards Committee (IASC), responsible for developing international accounting standards, was established in June 1973. It is presently known as International Accounting Standards Board (IASB). I repeat, IASB. The IASC comprises the professional accountancy bodies of over 75 countries, including the Institute of Chartered Accountants of India. Primarily, the IASC was established in the public interest to formulate and publish international accounting standards to be followed in the presentation of audited financial statements. International accounting standards were issued to promote acceptance and observance of international accounting standards worldwide. The members of IASC have undertaken a responsibility to support the standards promulgated by IASC and to propagate those standards in their respective countries. Between 1973 and 2001, the International Accounting Standards Committee released International Accounting Standards. Between 1997 and 1999, the IASC restructured their organization, which resulted in formulation of International Accounting Standards Board. These changes came into effect on 1st April 2001. Subsequently, IASB issued statements about current and future standards. IASB publishes its standards in a series of pronouncements called International Financial Reporting Standards (IFRS). However, IASB has not rejected the standards issued by the ISAC. Those pronouncements continue to be designated as International Accounting Standards (IAS). The IASB approved IASB resolution on IASC standards at their meeting in April 2001, in which it confirmed the status of all IASC standards and SIC interpretations in effect as on 1st April 2001. Moving on to the International Financial Reporting Standards as global standards. The term IFRS comprises IFRS issued by IASB, IAS issued by International Accounting Standards Committee, and interpretations issued by the Standard Interpretations Committee and the International Financial Reporting Interpretations Committee of the IASB. International financial reporting standards are considered a principles-based set of standards. In fact, they establish broad rules rather than dictating specific treatments. Every major nation is moving toward adopting them to some extent. Large number of authorities requires public company to use IFRS for stock exchange listing purposes, and in addition, banks, insurance companies and stock exchanges may use them for their statutorily required reports. So, over the next few years, thousands of companies will adopt the international standards. This requirement will affect about 7,000 enterprises, including their subsidiaries, equity investors and joint venture partners. The increased use of IFRS is not limited to public company listing requirements or statutory reporting. Many lenders and regulatory and government bodies are looking to IFRS to fulfill local financial reporting obligations related to financing or licensing. We will now discuss the adoption of IFRS in India. Increasingly, Indian accountants and businessmen feel the need for convergence with IFRS. Capital markets provide an important explanation for this change. Some Indian companies are already listed on overseas stock exchanges and many more will list in the future. Internationally acceptable accounting standards are becoming the language of communication for Indian companies. Also, the recent stream of overseas acquisitions by Indian companies makes a compelling case for adoption of high quality standards to convince foreign enterprises about the financial standing, as also the disclosure and governance standards of Indian acquirers. Convergence with IFRS will require several changes in Indian laws and decision processes. In India, the Institute of Chartered Accountants of India is on the way towards convergence of its standard with global standards. Divergence have been minimized to the maximum possible extent in the areas wherein full convergence is difficult. Recognizing the growing need of full convergence of Indian accounting standards with IFRS, ICAI constituted a task force to examine various issues involved. Full convergence involves adoption of IFRS in the same form as that issued by the IASB, while formulating the accounting standards. ICAI recognizes the legal and other conditions prevailing in India and makes deviation from the corresponding IFRS. To bring Indian standards at par with the IFRS, some of the earlier accounting standards and guidance notes have been revised or are under the process of revision. However, at present the Accounting Standard Board, in consultation with the core group constituted by the Ministry of Corporate Affairs for convergence of Indian accounting standards with international financial reporting standards, has decided that there will be two separate sets of accounting standards, viz. First, Indian accounting standards converge with the IFRS. The MCA has hosted 35 converged Indian accounting standards without announcing the applicability date. These are the standards which are being converged by eliminating the differences of the Indian accounting standards vis-a-vis IFRS. Second, existing accounting standards. The entities not falling within the threshold limits prescribed for IFRS compliance in the respective phases shall continue to use these standards in the preparation and presentation of financial statements. Let us now recapitulate what we have learned so far. ICAI, the premier accounting body in India, has constituted ASB in 1977. Accounting standard setting and issuing procedure is initiated by ICAI and it's completely first consultative and second transparent. In the standard setting process, ASB considers the following international standards while drafting the standard: International Accounting Standard IAS and International Financial Reporting Standard IFRS. ASB follows certain procedure while setting up accounting standards, which is as follows. First, identification of the area where accounting standard to be formulated or amended as of today according to needs of the industry. Second, based on identification areas or subject, it will prepare a proposed accounting standard. Third, based on the proposed accounting standard, ASB will constitute study group which will prepare the preliminary draft, which that includes A. Objective and scope of proposed accounting standard, B. Definition of the terms used in the standard, C. Recognition and measurement of accounting principles and where such principles are applicable, D. Presentation and disclosure requirements of the accounting standard. Fourth, the preliminary draft prepared by the study group will be deliberated by ASB. Fifth, the reviewed draft will be circulated for comments. Sixth, exposure draft will be issued in public for comments. Seventh, after consideration of public comments, exposure draft will be forwarded to the Council of ICAI for approval. Eighth, Council of ICAI will verify the final draft. If any alteration is to be done, then draft will be modified with the consent of ASB. Financial Reporting Authority NFRA shall be responsible for monitoring and enforcing compliance of auditing and accounting standards. Thank you.